We're coming to the end of the trading week, but first it's time for another Targets in Focus programme. Joining me on the line today is James Bevan, CEO of CCLA. Hi James, thanks for joining us today. After the Bank of England's minutes were released earlier this week, it became clear that more QE is not currently on the agenda. So could you give me your short, mid and long-term predictions for the euro-pound?
We're looking for euro-pound to move modestly in the months ahead. The key challenge here is that we think that there is now reduced downside revision scope for inflation forecasts. That weakens the case for an expansion of asset purchases, but also reduces the risk of debt monetisation, which should support the pound against the euro.
And what about your 1, 3 and 12-month predictions for the pound yen?
For sterling yen, we are looking for 1 month to be broadly stable, in 3 months a rate of 126.60, and on 12 months a rate of 130.40. We are relatively bearish the yen against the US dollar, and this reflects the new Bank of Japan's emphasis on inflation, combined with the improvement of global risk appetite and a continued deterioration in Japanese trade dynamics. The key challenge clearly is that the Bank of Japan now will have to expand money supply and gain economic traction, given its inflation target, and this will underpin the credibility or lack thereof of the Bank of Japan. The premise, therefore, must be that the Japanese yen weakens over the months ahead.
And finally, I'd like to look at traders' favourite pair, euro-dollar. What are your short, mid and long-term predictions for this pair and why?
For US dollar against the euro, we are looking for the current rate of around 131 to move modestly to around 130 in 1 month, 129 in 3 months, and 128 in 12 months. We are relatively bullish of the dollar, and we expect the dollar to strengthen against the G10 currencies through the year. This is on the back of US data flows that have been improving, at least on a relative basis, and while central banks in both Europe and Japan have been re-expanding their balance sheets, the Fed has been taking less action. On the other hand, the improvement in global risk conditions triggered by the declassification of Europe's debt problems from systemic to ongoing, declining commodity price volatility should benefit high-yield emerging market currencies, and therefore we are not an outright bull of the dollar.
Well, thank you, James. That's all we've got time for today, but stay right here with DukascopyTV for all the latest FX news and exclusive interviews.